Welcome back. If you follow gold and silver with discipline instead of emotion, you already understand why this channel exists. We're not here to echo headlines or repeat recycled narratives. We're here to identify when markets stop behaving normally and start revealing structural truth. If you are new here, subscribe now. What we are discussing today is not routine price action. This is not a standard bull market. This is a regime change. A few months ago, I said silver could reach 60, maybe even 70 by year end. Those levels may still occur. But focusing on price targets now misses the real point entirely. Price targets belong to linear markets. What we are entering is not linear. Silver is not simply moving higher. Silver is exiting an old framework and entering a new monetary reality. For months, we warned subscribers that silver was approaching what we call a jolting phase. This is the point where markets stop moving in orderly steps and begin repricing violently. Not gradually, not politely, abruptly. This signal did not come from silver trending higher. Silver has trended higher before. That alone is meaningless. The signal came from relative behavior, and relative behavior is where real capital decisions are revealed. Let's start with gold versus equities. If you chart gold divided by the S&P 500 over the past decade, what you see is not a trend but a massive base. For years, gold would outperform stocks briefly, then give it back, over and over again. The market was undecided. That indecision ended in November. Gold didn't drift above that range. It broke out decisively. Within weeks, gold gained hundreds of dollars while the ratio expanded aggressively. That is not noise. That is a generational shift in asset preference. Then the confirmation arrived. Gold and silver miners relative to the S&P 500 broke out at the same time. Same month, same structure, same message. Capital chose metals over equities. When multiple independent ratios break out simultaneously after a decade-long base, that is not coincidence. That is capital reallocation. Now silver enters the equation. Silver didn't just break out on its own, it broke out relative to gold. That matters more than most people understand. When capital moves into monetary metals, the next decision is leadership. The market answered that clearly. Silver is leading. Silver also exited what we've described as its 50-year prison, roughly between $4 and $50. Half a century of sideways suppression conditioned investors to believe silver goes nowhere. History tells us what happens next. We've shown subscribers similar multi-decade ranges in copper and lead. When those ranges finally broke, prices didn't double. They quadrupled within 2 quarters, not slowly, violently, because markets occasionally realized they were wrong. And when they do, correction is not gentle. Silver is now displaying the same structural signatures. This is not hype, this is architecture. And this leads us to the real issue. What kind of environment produces this type of breakout? The answer is fiat confidence erosion. We are not in a normal commodity cycle. We are entering the early stages of a sovereign-level confidence crisis. This is where most analysts lose the plot. Silver is no longer trading primarily as an industrial input. That shift begins quietly, then it accelerates suddenly. Once it happens, old valuation models become useless. For decades, silver suffered an identity conflict. Half industrial, half monetary, respected by neither. Industrial users treated it like copper. Monetary analysts treated it like cheap gold. Both were wrong. Silver did not change. The currency measuring it did. Gold and silver do not gain value. Fiat loses credibility. When gold doubles, the currency halved. Silver is now responding to that same erosion, but with leverage, because it was structurally suppressed for decades. This is why platinum is not the same story. Platinum behaves industrially. Silver behaves monetarily with industrial demand layered on top. That distinction is critical during monetary resets. Zoom out further. We are approaching a sovereign debt inflection point. The United States, Japan, Europe, and the UK all carry debt loads. These loads cannot normalize without systemic damage. Central banks are trapped. Raise rates and break the system. Cut rates and destroy the currency. There is no third option. Markets sense this before analysts do. That is why gold broke out versus stocks. Why silver broke out versus gold. Why miners broke out versus equities. These are not isolated moves. They are capital migration signals. Now let's talk historical behavior. In 1979 and 1980, silver quadrupled in roughly 5 months. In 2010 and 2011, it surged dramatically. Both followed long consolidation. Both moves shared a common trait, a midpoint pause. Halfway through acceleration, silver hesitated. Analysts declared the top. Weak hands sold. Then the second leg exploded harder. We believe we are at the beginning of that clock now. The breakout triggered in late November. The first phase is rational participation. That likely extends into February or March. Somewhere in that window, a pullback is expected. That pullback will not be the end. It will be the trap. If you hold silver as money, you do not trade that noise. You endure it. Because after the midpoint comes recognition. That is when markets realize this move is not normal. When buyers fear price, demand slopes. When buyers fear availability, demand goes vertical. That is when markets stop behaving academically. They start behaving emotionally. Now let's address supply. Industrial demand is rising. China dominates refining. Investment demand is increasing simultaneously. This alignment destroys textbook supply-demand assumptions. At the same time, fiat currencies are eroding together. This is global, not localized. Silver reacts first because it is small, liquid, and hoardable. Volatility confirms this. After decades of suppression, volatility does not return calmly. It returns explosively. Sharp daily moves are stress signals, not speculation. This does not mean straight-line price action. Corrections will occur. Shakeouts will occur. Volatility transfers metal from weak hands to strong hands. What makes this cycle different is that suppression mechanisms are failing. At this stage, price targets are secondary. The real question is what silver represents. Silver is a pressure gauge. If silver were irrelevant, it wouldn't need suppression. If it were abundant, it wouldn't be volatile. If it were unimportant, it wouldn't matter. The market is communicating something. Whether people listen is another matter. From an investor's perspective, silver is not about upside fantasy. It is about protection. Currency risk, policy failure, purchasing power erosion. Those risks do not disappear during calm periods. They accumulate silently. As we move deeper into 2026, instability is not resolving. It is being deferred. And a deferral always carries a cost. Silver reflects that cost in real time, whether silver surges next week or consolidates for months or shocks the market again. The message remains unchanged. The structure has shifted. The old playbook is failing. Control no longer guarantees containment. That is why this moment matters. Not because it is exciting, but because it is revealing truth. And once truth is exposed, it does not return to the box. Let me know your view. Is silver a trade, a hedge, or long-term insurance? Share your thoughts. And if this analysis added clarity, make sure to subscribe. We will continue cutting through noise and focusing on what actually matters.
Hello friends, welcome back. So friend, if you follow gold and silver with discipline instead of emotion, you already understand why this channel exists. We are not here to echo headlines or repeal recycled narratives. We are here to identify when markets stop behaving normally and start revealing struggle truth. If you are new here, subscribe now. What we are discussion today is not routine price action. This is not a stand bull market. This is a regime change. A few months ago I said silver could reach 60, maybe even 70 by year end. Those levels might still end, but focusing on price target now missing the real point. Entirely price target belong to land market. What we are entering is not linear. Silver is not simply moving higher. Silver is exact and old framework and entering a new monetary reality. 4 months we want subscribe that silver was approaching what we will call a jointing pace. This is the pointing where markets stop moving in orderly steps and begin repressing violently, not gradually, not polity abruptly. This signal did not come from silver trending higher. Silver is trending higher. So friend, like this video and subscribe my channel. Thank you so much.